Hey everyone, today we're here with Judd Arnold from Lake Cornelia Asset Management or Research Management to talk about an industry that he describes as the next cloud computing in terms of being a big trend that is hopefully going to become a more meaningful part of the healthcare industry. Judd, welcome to SumZero. I'm looking forward to this discussion. You obviously have a long history, managing money professionally. You've worked at Anchorage, Neuberger Berman, and some other big funds. Just tell us a little bit about your background, just to start off with, and then we can get deeper into value-based care and Cano Health.
Sure. No, thanks for hosting. This is awesome. I posted my first thing on SumZero, I think in 2011, and it's been a great journey. I really appreciate it. I got some cap intro stuff on your site. I got some research on your site, and it's just a great product, that I've used for a while. So my background, which I'll get into real briefly, I was an athlete in college. Then I worked at Lehman Brothers in banking. Went to King Street Capital Management for about 6 years. Then Anchorage Capital. Moved over to Citadel, where I did market neutral, event driven. My team spun out. We launched a hedge fund at Neuberger Berman. And currently I run my own money, as well as a firm called Lake Cornelia Research Management, which does two things. We are part of an RIA. I manage discretionary accounts for mostly Wall Street guys who can't run their own PA. And I've got a structure that I've gotten through compliance at a bunch of banks and funds. And also I consult for a few family offices and investment funds where I just sell ideas a la carte. The basic structure of what I do is, I'm putting on these positions. I'm trying to compound my money and trying to find stuff that just makes sense and is going to compound money over time. And to the extent people want to come with, I'm happy to have them.
Appreciate it. Well, we want to talk about a stock that you have a pretty meaningful position in, that you argue is at current levels 50% undervalued, but with a long-term trajectory beyond that, Cano Health. But before we get into that, I just wanted you to give listeners just some background on the industry that Cano operates in, value-based primary care. So what is that for folks who maybe aren't as aware of that trend, and where's it heading? How does it compare to traditional healthcare services? If you can just give us that background as a backdrop, that'd be super helpful.
Yeah, perfect. And look, there is a presentation that I put out. If it hasn't reached you, it's also on Twitter. It's also on SumZero. My Twitter page is Cornelia Lake or Lake Cornelia, and you should be able to find a link to it. And I'll be referencing that. Everything's posted on SumZero, including my initial 61-page memo. So it's just value-based care at the most basic level is we're going to spend about 5% of money in the healthcare ecosystem is spent at the primary care level with your doctor. And 95% is everything else, with the biggest amount being hospital stays. And the idea is, if we can spend as a system, society, what have you, if we can increase what we spend at primary care, which literally just means instead of going to your doctor once or twice a year, usually when you're sick, we can make you go to your doctor 7, 8, 9 times a year. And you build a relationship with that doctor, and we invest in preventative care. And just ultimately, it's kind of like the dentist. If they shame you into being a little healthier, we can take that 5% that we spend on primary care, maybe increase it to 7, 8, 9, 10% of the pie. And by doing that, we're going to reduce the 95% to some much lower number, like 60, 70%. And what we've seen is, today there's roughly 1.5 million people in what's called so-called value-based care arrangements out of a Medicare population of about 62, 63 million. And what we've seen over the last few years, as this has sort of grown as an industry, is hospitalization rates go down anywhere from 30 to 50%. Diabetes, which is a huge, diabetes is, we do a whole call on diabetes. That's a whole ecosystem. A lot of that is lifestyle driven, and you're seeing massive reductions in that. You're seeing extended lives. And by doing that, patients are winning because obviously they're getting better healthcare outcomes. Costs to the healthcare system are going way down. And that's, as we, enter the baby boomers into retirement who are already there, and maybe, people you are my age as well, sort of it's up there. This is something that needs to win. And it's also something in healthcare. And admittedly, I started as an energy guy. Generally in investing, you're like, don't fight the Fed. In healthcare, it's don't fight CMS, Centers for Medicare and Medicaid, which are the biggest payer out there, and the 5 big health insurance companies as well. Don't go against the trend. Centers for Medicare and Medicaid, all the big payers, United Healthcare, Humana, Aetna, and what have you, are all pushing more and more into this. And it's my expectation, and really the market's expectation, that 1.5 million out of 62, 63 million over the next decade is probably going to be somewhere between 30, 40, 50 million, or, said differently, 60, 70% of the total Medicare pie, which is going to keep growing. And so that's the opportunity in a nutshell. And what we have is a new public company ecosystem. It's roughly a market cap of, call it 50 billion. Now that's not all distributed right now, but you got 50 billion in market cap that's likely going to grow to, 100, 200, 300. It's going to be a big number. You've got now 8, 9 companies in this ecosystem. All of them are new. None of them existed in the public market 2 years ago. And so you've got this just tremendous tailwind. I would say you will not go wrong if you buy all of them. If I was at my first 2 funds, which were $15, $20 billion funds, given the market cap and liquidity, I would have been saying buy all of them. With Cano, because it went public via SPAC, and we'll get into the history a little bit of why it came public and how it could have IPO. And there's a story there of what happened. Cano, you have 2 trades. Number one, the public market reprice. The valuation is a 50 to 60% discount versus pure play public comparables. And so from 1250 today, I think the stock should be 25 to 30 right now. And then after you get to parity with the other ones, you still have a multi-year, multi-bagger opportunity to build on from there.
So let's talk about the other players in the space. You mentioned there are around 8 names in the public markets right now, total market cap between them around 50 billion. Are those other players essentially doing the same thing as Cano in different markets, or how are they all differentiated from each other? Is it mostly geographical, or are they providing a different set of services entirely? How would you describe those differences?
Yeah, the points of differentiation generally fall along geographic differences, slight differences in the care model, and then differences in the growth model. And so we'll start with this. Cano, the biggest states for Medicare Advantage, where the most old people, not shocking, Florida, Texas, California, New York. And what are the places growing the quickest? All the sunshine states. So Cano actually has the best geographic exposure of the public companies because it's based mostly in Florida, and also deals much more heavily with the Hispanic population, which is a great population to address. There's a secondary population to focus on, which is the Medicare, Medicaid dual eligibles. These are people who need a lot more care, typically lower income. And these are the people you can help the most, and i.e. make the most money because you're helping them the most. Oak Street, first one to go public. About a third of the company is Illinois. That's where the founders are from, and that's sort of the legacy there. They are expanding nationally. I would say they're basically everywhere but Florida, and they have a small footprint in Texas, but they're much more dispersed, where Cano is much more concentrated. Agilon is the third biggest one, which is a unique model. They don't own anything. It's more contracted, where they go to doctors' offices and they say, look, the way value-based care works is you take all the risk. So the way the economics go, this is sort of slide, where we're sort of into the value-based care slides. This is slide sort of 13 if you're looking, if you want to see it graphically, and this is a good time to step back and sort of explain this. The way that we incentivize the primary care guy is the payer, be it Medicare, Medicaid, or Humana, whatnot, Humana, Aetna, whoever, goes to the primary care guy and says, here's $1,000 a month per member, per member per month. You wear all the risk. You have to go out. If they go to the doctor, that's coming out of your end. You're in control. You're the quarterback. We step back. We don't assume any risk. If you can't service these patients at that price, you're going to lose money. And so you take the Oak Streets, the Canos of the world are taking full risk, and they're doing. They have the clinic. They've got the doctors. Some Cano has affiliates as well. There's it's not 100% owned, where Oak Street's 100% owned. AGL is the polar opposite. And now we're back to slide 6 as I frame this, and I'm going to focus a lot on just AGL, Oak Street versus Cano. as we talk, because those are the three biggest ones. So slide 6. So Oak Street's 100% de novo. They build all their own facilities. They fully control them. They're all Medicare population focused. AGL goes to, I'll call them richer doctors' offices, where the patients are better off. And they go to these people who, they service from babies on up to senior citizens. And they say, look, you keep doing what you're doing, but we will own all the risk on the Medicare population that wants to do value-based care. So you, the doctor, you make, $200,000-$300,000 a year. You don't have to sweat whether you're going to be out of money because you did it wrong. And we're going to help you. We're going to give you a technology stack. We're going to give you some leverage, something called an MSO, which is a managed service organization, which is pooling doctors to get leverage over hospitals. We're going to be effectively a mini MSO for you and a service provider. And for that, we want 50% of the profits on a 20-year contract. So it's two massive extremes on a delivery level, and Cano's sort of in the middle, which is it's 100% owned. They do MSO. They don't do the profit share. But I'd say the geographic, the growth strategy difference, which is sort of the last piece, where Cano is willing to do M&A, and that's the other big differentiator, where AGL is buying into doctors' offices, not doing company clinic deals. Oak Street's doing 100% de novo. So if
I'm a doctor, like if I'm a primary care physician, and I get approached by Cano to join one of their clinics, what are my economics? And what risk am I taking through Cano?
Yeah, well, you're going to be owned by Cano. So there's two ways to participate. There's you sell your clinic to them, and then you're an employee of Cano and they pay you, in which case you're an employee. You'll probably get some equity in Cano. But you've now gone from owning your own business to being part of a much larger organization. So you don't have to deal with back office, mid office, and you get sort of the scale of their organization. You also get their big technology stack, which is another big thing that Oak Street, AGL, Cano, and really the whole industry talks about. So Cano has something called Cano Panorama. Oak Street's got, I forget what their thing's called, but they all have one, which, in a world where we've got telehealth and you've got all the like Teladoc and all those companies, all of these guys are really revolutionizing the technology stack, bringing in data. You go in, you meet with the doctor, you plug it into Cano Panorama, and the doctor's got all this information on you, recommended sources of care. It also plugs into the payer system in terms of payment accuracy and payment integrity, which is something Cotiviti and a little bit of MultiPlan does. So these guys are all encompassing both technology, leverage scale. So
would a specialist be relevant to a Cano, or is it? I mean, the idea of value-based care, does it even apply to specialists, or is it only applicable?
It does in a way, not directly the way you're talking, but it's a huge part of it. So about 60-70% of the payments go to third party of the cost structure. You take revenue that comes in, and the money that goes out goes to third party medical expenses. And so at Cano, Oak Street, AGL, what they're focused on doing is, hey, we've taken individual primary care doctors who have, 1,000 pages. We're showing up in Florida, this is Cano. I've got 150,000 people. You're the best, anesthesiologist. We're going to directly contract with you. You don't have to worry about anything. We think you're great. We've done all the metrics. We're going to send everybody to you. You're the best oncologist. We're going to scale up into you, and we're going to give our patients the best outcome because we're getting you the best doctor, and we can quantify why you are the best doctor. And so all of it, this whole thing only works. And obviously if the patients get, have better outcomes, secondarily, if we can reduce and optimize that third party medical expense. And what we're really doing, and when you think back like 10, 20 years ago, why HMOs failed. In the HMO model, we went to the insurance company, the guy you don't want to incentivize to say you're in charge of costs. And what do? They're like, who's the cheapest? It's like the government, you're going to space and you're like, okay, it's a rocket built by the lowest bidder. We don't want the lowest bidder. We want the best value for the patient, which means who delivers the best outcomes at, a reasonable price. And it's also because of the technology stack. It's not like Cano, AGL, Oak Street, and the whole ecosystem aren't going to go to all the specialists that they're outsourcing to and say, hey, we'd love to deal with you. Here's all the metrics though. You underperform this other doctor on all these things. Let's talk to that doctor, find out what they're doing, and maybe you can improve your practices. Because we're centering and incentivizing and letting the primary care physician be the quarterback, you're going to get better outcomes. That's the whole thing. And that's what they're all doing.
Super exciting stuff. Let's talk a little bit about the SPAC itself, because I know it's, SPACs have become a little bit of a four-letter word, and I know a lot of folks don't necessarily trust them. Sometimes that's rational, sometimes it's not. But can you just give us a little bit of history on how Cano went public, who's involved, who the players are, just all of that?
Sure. And I'll just say, look, at a high level, your point's right. Like SPACs have an adverse selection bias, obviously. And there's a threshold question of could these companies that have gone public? I only invest in maybe 1% to 2% of all SPACs. The ones I'm looking for, my checklist, and I put it in the Cano memo that I published in March, is number one, could the company have gone public? What that means is this big enough? Is it real? Is management awesome? Could this, had they have gone traditional IPO, would this have been a successful IPO? Most SPACs can't say that. They're either pre-revenue, they're not ready for prime time. It's a little, it's a little shady, like a Lordstown Motors, where you're like, this would have never worked, and so forth. Cano checks all the boxes of something that could have gone public, and it would have been a successful public offering. I think on a SPAC adjusted share price, what I mean is all SPACs come at 10, except for Bill Ackman's SPAC because he's special, but most SPACs come at 10 bucks. Would this thing reasonably have traded, mid 20s at the end of day one of the IPO? And the answer, I think with Cano, I think it's quite clear. Parity with Oak Street on an EV to revenue basis is $35 a share. The stock's at $12.50. You think about how big that gap is. So the history on the SPAC is it's Barry Sternlicht, who's a big guy, Starwood Capital, real estate guy, but I think more than real estate, he's just a phenomenal investor, incredibly detail oriented. This was his first SPAC. He raised about $700 million. The other people in the SPAC GP are the O and GSO, Doug Ostrover, who's now at Owl Rock or whatever, Blue Owl, whatever the thing's called, and the former CIO of Brown. So first SPAC sponsors, that's a first level threshold thing. There's a lot of people that you probably shouldn't want to deal with in your regular life who do SPACs, and, buyer beware. I think checking the SPAC sponsor is a big deal.
Yeah, I think a lot of the SPACs seem to be, there's like a self-promotional celebrity factor that I think rubs people the wrong way. Barry seems, at least, given his track record, kind of coming from a very different place. And, he's obviously incredibly successful in his own right. But the other guys you mentioned, also incredible track records. And then they also did a PIPE. So can you just tell us a little bit about the PIPE that they raised?
So concurrent with what led to the SPAC were these PIPEs. So it used to be you announce a SPAC deal, you got to get 80% of the people to vote yes. And so there's a huge risk that the deals don't happen. So first of all, they changed SPACs to opt out versus opt in. So you have to physically redeem to get out. Secondarily, these PIPEs has made it so the minimum proceeds that you need to close the deal were essentially guaranteed. So in the case of Jaws, I think 70% of people could have redeemed and the deal would have closed. The SPAC, the PIPE, the history of the PIPE is a real big, a real big story of how we got here. So the deal was announced, and let's go a little further back. So back before the PIPE, and because I think it's important and relevant as we get to the PIPE, which is InTandem partnered with Dr. Marlo Hernandez, who is the founder of Cano, in about 2016 or 2017. Marlo, who's like a 39-year-old, I'd say guy, but that's because I'm just casual about it, but a very impressive individual who basically after medical school started this company, partners with InTandem. InTandem is a very under the radar growth equity private investment firm. I wouldn't really call them private equity. They're started by this guy, Elliot Cooperstone, who used to be the CEO of Prodigy Health. Incredibly impressive guy. Him and his team of operators, there's less than 10 investment professionals at the whole firm. They partner in tandem with small healthcare organizations and help them grow. and scale their businesses. So InTandem comes in, and InTandem, just for reference, they manage less than $1 billion. I think their first fund was less than 200. Their current fund, I think, is 200 or 300 million. The current market value of their shares in Cano, now that they're public, is I think 1.7 or 1.8 billion dollars. Like, this is a monster win. This is one of the best private equity investments in the last 5 years. But most people in the public markets don't see InTandem ever. They haven't, because most of the time they just exit to other in sales. So InTandem sitting there with this great investment. Obviously, the original investors in Cano are doing incredibly well. And because of InTandem, Cano has never had to raise money. It's not one of these companies where it comes public, you pick up the phone, you call the private guys, and they're like, oh yeah, this thing's been around for 6 years. They know everything. Literally nobody knows anything about Marlowe or the company because they've never had to raise money. And so you've got InTandem there with, a firm defining win. And they launched a private equity sales process at the start of 2020. You ended up, based on the market intelligence that I've been able to gather, they've got at least 2 private equity bids and potentially a Canadian pension fund put in final round bids. And they all bid roughly 20 times EBITDA last spring, last summer. And this was before Oak Street had gone public. Oak Street went public at about 21, 22 a share. Oak Street in 2019 did a funding round, I think at $2 or $3 a share. That's how much this industry is growing. Wow. So, and you talk to the private equity guys, you go back and forth, and because there's a disparity. The private equity guys were kind of 20 times EBITDA, call it 2 to 2.5 billion. And the SPAC deal happened at about 4 and change. And you're like, what's that gap? The private equity guys said, effectively, we love everything about this company. We've done deep due diligence. Marlowe's great. We think this platform's awesome. We think the value-based care thing's got a way to grow. We just are capped internally. We're private equity. We can't pay more than 20 times EBITDA. I can't go to investment committee at that. And then you push back and you say, well, look, Oak Street has negative EBITDA and it's trading at a premium on a EV to revenue basis. Are you saying you couldn't justify Oak Street? And they all kind of said, like, look, we get it. It's just not what we do. We have to put leverage on a company. And, we're not sure we believe Oak Street's worth 10 times current year revenue. Maybe it's worth 5 times. They went public, I think, at 3.5. And right now it's trading at 7 times 1 year, 2022, north of, I think it's 11 times 2021. So the private equity guys had all this uncertainty and they just couldn't get there. Meanwhile, InTandem sitting there saying, look, I'm up huge. I need to ring the register. This is just defining. Out of the woodwork, Barry raises one of the top, Barry Sternlicht raises one of the 10 biggest SPACs ever at about $700 million. Does maybe a month of calling around his network, and obviously his network's pretty impressive. Yeah. You got to talk to this guy Marlowe. So Barry's in Miami, Marlowe's in Miami. They have a meeting of the minds. Barry's really impressed because deep down, Barry, even though he's a real estate guy, is really a growth stock guy, loves the entrepreneurial vision. So Barry does a bunch of due diligence as well. And I mean, Barry went clinic by clinic by clinic. And this is a huge thing in terms of, is this company able to IPO? When I've talked to people, because people don't know Marlowe, and let's just put it all on the table right now. People hear doctors, primary care, Medicare, Florida, some acquisitions, and like alarm bells and red flags just start going off for people in terms of their past investment history and all the times that this has gone wrong. Marlowe and Cano have been aggressively due diligence in the last year by Barry hiring KPMG to go clinic by clinic on all the accounting and obviously doing everything. And you got Doug in there, and I don't know the Brown guy, but like, you've got real people doing their first SPAC, which has to win. Like, you're not screwing up your first SPAC. They go deep in the weeds. You had at least 2 private equity firms put in final round bids. They definitely hired that CIA Mossad background check thing that I used at Anchor. Yeah, everybody uses them. It's fine. Like, and you had the Canadian pension. Like, this company, while it's not known, these, like, every stone has been turned over in terms of the facility accounting level, all the executive backgrounds. And let me go back to InTandem because I know a little bit about them and most people don't. Elliot, who runs InTandem, is been described by multiple people to me as a Marine and like honest to a fault. His whole thing is installing processes and in making companies that, just operate better. So, and that heritage has been with this company for a really long time. So people, when you talk to people about Cano, it's like, oh my God, they've done a few acquisitions. Maybe they don't know what they're doing. And I talked to some, some industry participants. I did a lot of expert network calls. I actually got a lot of great people. I talked to the president of one of the biggest private ones in value-based care, a lot of heads of business development, and they all kind of, you couldn't sort out, is it competitive zeal? Is it what? But they're like, who's this guy? I don't know. And then you go deeper and you're like, there's been a lot of work on this guy. So back to the pipe. Barry signs up the deal, and you can read it in the proxy and the deal background. He signed up the deal about $5.5 billion, which worked out to about a 20 to 30% premium to the Oak Street IPO valuation, which was 21, 22. Meanwhile, Oak Street at the time was in the 40s. Today, it's in the 60s. Pipe market shuts down. People are new on value-based care. You've got one comp. And while they got the pipe done with an all-star roster, I mean, it's a 75 million share pipe, excluding Barry. Barry's got another 5 million shares himself, and Barry almost never goes public, but publicized investment. Of the 75 million external shares, 25 million are Fidelity. Blackrock and Capital Group each took 8.5 in terms of long-only sponsorship. You've got Third Point. You've got HealthCore. HealthCore, people don't know about it. Ex-SPAC portfolio manager from, I think, well, now it's like 15 years ago. I mean, the guy he's the HealthCore guy now. It's one of the best healthcare firms out there. You've got a lot of other really sharp people in this name that did the work and got them. Maverick's also really big. I'd be remiss. All these guys as well are also in Oak Street, also in AGL. There's another small one called CareMac, which was a different SPAC. These people are all over this ecosystem. But the issue was you only got 12 guys, and most pipes are 25, 30, 40, 50 people when you look at the S1s. So you got a lot of onesies and twosies. And I think part of the choppiness of how Cano is traded since the D-SPAC, it's not that these guys are liquidating, it's that it's a little bit like a cold IPO or a 4 to 6 times covered IPO, if you will, where the guys who wanted it got filled. And they're kind of, are they going to buy more? Not as much as if they got much smaller allocations, obviously. Additionally, the other big thing with SPACs is it's a game of transition. The guys who buy SPAC IPOs are called the SPAC Mafia or SPAC ARBs. They're buying every single one of them because you get warrants, and the warrants with the stock is worth $10.50 and the IPO happens at 10. And so if they announce the deal, you flip it, you recycle capital, and you go on. What that means is every SPAC has to go through a transition to the permanent shareholders that are going to own the company. And you look at Cano, which was Jaws before, I think there's been 7 13Gs filed since the deal. There's a big long only in Denver, Citadel, obviously one of the big pod shops where I used to work, filed a 13G as well. Suvretta, I think Owl Creek, Owl Creek. I mean, you can look on the list. There's a lot of people that importantly invested after the deal was announced. So these are people that want to own the stock. So
on that, I would say on that note, there's the relative valuation argument that you're making against OSH. Just going to maybe just your thoughts on the absolute valuation of the business. How do you think about it? I mean, what is the what are your thoughts on just kind of like normalized EBITDA margin? What metric do you think is the most relevant one to look at? Is it EV to sales, or is there something else that makes more sense? I mean, I'm just curious how you think about it as a standalone business, not just simply looking at it compared to the comps.
Sure. Cano is the only one with EBITDA. Oak Street has negative EBITDA. Iora, which was just bought out, one of the private ones, for 7 times revenue by One Medical, that had mass, $300 million of revenue and negative $50 million of EBITDA, and is worth $2.1 billion. But what the market is saying is we're going to value these things right now on EV to revenue because the TAM is so big.
Right.
And we're going to think conceptually about the terminal margin. So Oak Street and Cano believe strongly that the terminal margins at the corporate level are about 20%. At the clinic level are about 25%. The way that we feel good about that, Oak Street puts out their cohort analysis where you can see facilities that have fully ramped up. An Oak Street facility takes about 4 years to ramp. The ones they have that are fully ramped are earning 25% margins at the clinic level. So call it 70, 80% of capacity. Cano, same thing. Fully ramped, you're doing 25, a little bit higher for Cano for some of their bigger facilities because they have more density in area and some of their facilities are a little bit bigger. And then at the corporate level, call it 20%. AGL, the economics are half because they only have a 50% profit share. AGL also doesn't have terminal. It's not worth a terminal if the contracts don't roll. And I'm a little skeptical that in a world where primary care, value-based primary care fully penetrates, that in 20 years, all these doctors are going to roll thing. But either way, even if you assume terminal value for AGL, their margins are only about 10%. And so what the leap they're making, and I think this was really laid out well by Nephron Research, which is the only sell side guy who covers this. It's Josh Raskin, who is the really respectable Barclays analyst. It's his boutique. His report's out there. I can't send it because it's subscription based, but if you reach out to Raskin, or you can get it, it's a great report. And what he does and what he sort of laid out in his note is, I'm going to value these things on EV to revenue, but I'm going to use the sensibility of whatever the revenue is, let's apply the terminal margin to make sure it makes sense. So at $1 billion, if we're going to trade these things at $1 billion of revenue, and we're going to, 5 times revenue, and we think it's 25% margin, we're saying 20 times EBITDA, just 20,
what is the 2021 expected sales for Cano?
1.5. So Cano's about 1.5 billion. 2022 is about 2.3 billion and 2.3, 2.4. And the 2023 guidance is from the SPAC presentation is 3 billion. And, the current market, the total enterprise value of the company today, is, call it 6.6 billion. But I think the bigger way, the stupid math is this. Let's talk, there's obviously going to be some capital usage to get there. But if they can get to, 1 million members, 1,000, under 1,000 per member per month, let's just call it 10,000 per member per year. It's $10 billion of revenue. This thing literally by 2024, 2025, potentially, or let's call it 2025, this thing could be trading at 0.4, 0.5 times sales, growing. The growth rate is just it's superb. Cano's growing 50-60% a year. Oak Street's growing 50-60% a year. The TAM, which is a big driver of this thing. So Oak Street really laid this out on their call, and other people have talked about it as well. Oak Street, at the time of the call that they did this I think it was the Q4 call, they're like, we have 100 clinics today, 100. The market value, the market potential for us is 10,000 clinics.
Right.
And, and you look at Oak Street stock performance around their earnings, like every earnings, it's the same thing. The stock will go down because they missed earnings and they lost more money. And then you get on the call and the CEO, who's amazing, reminds everybody, he goes, the quarter doesn't matter. Nothing matters. We're growing. If the terminal economics are there, I'm going to take this thing from 100 clinics to 10,000 or some absurd number. Same thing for Cano, where they're going to go from, they're getting now to 250,000 members in 2022. They're going to end up 3, 4, 5 million. And I think that's the other thing, which is you play the end game out. I think what the market's saying about value-based care is that CMS and all the big payers have an assurance issue. They're going to shift. You think about where it's going to go. All the risk is going to go to the primary care guy, and they're going to be pseudo administrators. Now you have Humana and United Healthcare, which are about 60% of the market in terms of insurance. They're doing a lot of owned as well. So they own a bunch of clinics, but they also have these affiliate deals with Cano, with Oak Street, and what have you. The question is going to be, and it's really for Humana, is the market going to give them a higher multiple if they take no risk and effectively are the plan administrator? Or that mix goes much more. And if we push that down to the primary care guys. Now I bring this up at the assurance thing. If you really go down that road, to its end, if you're Humana, what's your biggest fear? I'm shifting the risk. These patient outcomes have to be better. I'm losing control. I need to be really sure that all the primary care guys that I'm partnering with can execute and can deliver. And what that means is if you're Humana, you're United Healthcare, which does much more in-house, you're Aetna, you need to invest heavily and partner with a series of guys who are going to win. And those guys, be it 6, 7, 8, 9 guys, are going to literally control the national space in 5, 10 years.
Got it. I mean, do you see some consolidation in the value care based?
We're already seeing it with Iora, and I think we should from here sort of go to like, you know, the other reasons for the call. But Iora just got, you know, as a private guy, they got bought out for 7 times by One Medical. Why? I'm sure they could have gone public, and I'm sure all the banks said we'll take you public at 5.5 times revenue. But you know, you're subscale, you're 300 million in revenue, you're like a little ant, and you haven't delivered. Your growth is, you know, 30-40% a year. You're in, you know, 2 states kind of, and you're going to be up against a bunch of really well capitalized guys with cheap capital. And if you go public and you get on the wrong side of this thing, you are going to lose. And so when medical shows up and says, okay, I'm a big company, my currency is already worth 10, 11, 12 times revenue. Why don't we just partner? I'll go in, and that solves that issue. So I think you're going to continue to see it. Obviously, we're seeing at the lower level. So Cano has done a series of acquisitions since they went public. They've done a $600 million deal, a $300 million deal. Last year, they did 2 big deals. And so you're going to see the primary care guys, and it's not necessarily the big corporate ones, but you're going to see smaller doctors practice continue to be consolidated, and you're going to take a very dispersed industry and you're going to consolidate it down over time. And I think it's also going to be driven by, you know, just attrition, because people can't, you're going to need scale. And the reason you need it is you need leverage over the third-party medical players, and you need the technology investment. You need to act as an MSO and improve processes at all your clinics, and ultimately improve the patients, which just only comes from scale. So it just becomes this self-fulfilling thing where a doctor working for Oak Street or a nurse practitioner or for Cano or for AGL is going to get better because they're part of that larger organization, and they're going to have the capital behind them. And so I think consolidation is inevitable.
What would you say are maybe the most concrete catalysts that will, you know, cause that valuation discrepancy to go away? And
and I think that this just sort of goes to the genesis of the call. Like, I'm not an activist, I'm not a research analyst, and how this came about is I'm independent. I put the memo out, and I do that just to get a little visibility, because it's hard to find family offices who want to work with me. It's just I'm one guy in sunny Miami. But you know, being out there, you know, ended up talking to obviously my network, but people on the fringes of it reaching out, and we all were a little concerned because the stock is just not doing what it's supposed to do. And part of that is a lot of self-inflicted process things. And what I'd step back and say is the IPO process is a well-oiled machine. You go on the roadshow, you meet with 1 million people. You got the sales force of all the banks pushing it out there. You've got research analysts on the phone. The street is educated. Here, you have a company that nobody knew in the private market because InTandem funded them. You had a pipe that happened, you know, in a tough time for the SPAC market with a new industry that wasn't really accepted. And then you had the SEC delay in March, April, May, where this thing should have de-SPACed probably by April, May at the worst. But the SEC came out and really just put a big pause on the SPAC market. These guys did an investor day in March. It was on one of the worst days for the market. Nobody dialed in. It was a little long-winded. And so you de-SPAC and nobody's heard of you. And then on top of it, they put a press release out saying, here's the Q1 numbers. Now it was June when they de-SPAC. Here's Q1. We're not going to have a call. No call. We'll talk to you in August. And I think you take all of that and it's just got orphaned. And then on top of that, the lack of sell side coverage. So you go public 45 days later, the whole street publishes, and they have to because they did the IPO. Here, I think because it was Barry and Doug's first SPAC, and obviously the company's not going to know what needed to happen, and I'm sure will happen on every other SPAC that Barry does, is Barry needs to do what Blackstone, KKR, or Apollo would do, which is call every bank and say, hey, I'm doing a lot of business with you, and you're going to cover my first SPAC. Right. You're going to cover it right now.
What's stopping him from doing that now? I mean,
I've had multiple talks with the company. And I think we're going to get a lot of initiations. I think all of that is happening. And I think, you know, I had a great call with the company, and, you know, I think we're going to get plenty. And I look, this is a huge ecosystem. This is going to be something that is going to be like, you can't cover Oak Street, you can't cover AGL and not cover this. I mean, from at the micro level, if you really want to get technical, the fact that the AGL and PRVA, which we haven't talked about, which is a lesser comp, but both of those very successful deals in the last month and a half, they went public. Half the analysts didn't even have Cano on the comp page. And so, you know, if you're a Blackstone, you're a KKR, you're an Apollo, like, you're going to call up all those analysts and just browbeat them. And again, Barry's a real estate guy. This is his first SPAC. Marlowe's not going to know this. The CFO, who's awesome. We haven't talked about that. They hired a new, you know, public company quality CFO. He was in the finance department of Aetna. He ran a division there. These people don't know to do these things, and there isn't the right people around them. Believe me, they know now. And I think we're going to see that. We're going to see multiple non-deal roadshows. We're going to see a lot of conferences, because where the rubber meets the road is this. This company cannot be here in 6 months, because one of two things is going to happen. They are in a massive cost of capital disadvantage. I mean, it's like, you cannot issue stock here. Oak Street, one of the big things that drove the stock forward was they issued about a $900 million convert, up 30. And with the cap call, it's really like an up 60% convert. It's free money to fund what, I mean, Oak Street loses about 100 million a year. They can fund all those de novos at a cost of capital of 2 to 3%. And their stock, if they want to issue it, you know, you're 7 times 1 year forward revenue. Cano's sub 3 times 1 year forward revenue, doesn't have the convert. Like, you can't do a deal here. You're just going to lose. You're going to dilute the existing shareholder base so much. So what's going to happen is one of two things. Either they're going to start executing on the public market, and as well, you know, with the actual execution of the company in terms of numbers and whatnot, it's important to remind people, Cano's raised numbers 3 times for 2021. They've affirmed and raised 2022 SPAC guides. There isn't a SPAC I'm aware of that has affirmed and raised 2022 numbers, nor could with a degree of certainty that Cano has done. Implicitly, they backed the 2023 numbers. If you look at the de novo guides, and you know, and you can play out the de novo schedule, 2024 and 2025 are locked in too. Like, this is as good as it gets with operational. So I think it's just that. If you don't get the stock moving, I mean, it's just too compelling and I mean, I think culturally you have a bunch of issues, but the accretion dilution of Oak Street buying these guys at 25 is ridiculous. And the idea that Barry or InTandem, and I don't know this, you know, I'm just saying objectively, it's such a big investment for InTandem. If anybody real came in at 25 today, this company is sold. It's sold easily, because Barry can declare victory. And how does InTandem not take this? It's like a 6x for their fund. And I think everybody would jump up and down. But I think that's the pressure on management. You have great alignment with Marlowe and his other co-founder, who we haven't talked about, who own about $800 million of stock. So I think they're going to get this thing, you know, there. And if you don't, like, we know how these things have ended, which is somebody's going to fix this.
What's their balance sheet look like now?
Very light on debt. They got like $500 million of debt pro forma. They can issue debt where the other ones really can't, because they actually have EBITDA. But I think that's part of the issue, which is you went public via the SPAC merger with, call it, $1 billion of firepower, about $600 million of cash, made $300 million of debt capacity. You fired that on for both deals. And so now you're through 2022. You don't really need capital, but if something came up, it's going to be hard to get there without diluting people. And I think management and the SPAC sponsor are well aware of that. And I think if we could just transition a little bit, because I do want to hit one more point, which is, you know, talking to people, just sort of the key pushbacks, you know, that I've gotten and the feedback I've gotten. So we're on slide 24 for people who have the deck. And we've talked about a bunch of these, but it's number one was management was unknown. And I sort of walked through, if you were on earlier, the CEO is, there's been a lot of work on that guy. There's been a lot of work on the company. There's a slight negative. The CEO is also the chairman of the board of directors, which is weird for a SPAC. It's weird for any company. And I think if a suggestivist or, you know, an activist showed up, I think one of the first demands would be, for ESG reasons alone, like you should have a separate CEO, chairman of the board. There's two women. I mean, if you really want to play the ESG arbitrage, there's two women on the board. I think, or there might be three women on the board. One of them is, senior executive at Cisco. I mean, you've got real people on the board who should be the chairman just for ESG reasons. And I think that would be, a win. They skipped the Q1 conference call. Obviously, that's spilled milk at this point. Humana competition and concentration is a weird one for me. There's only 5 big payers. And yeah, Humana is like 60% of revenue. Same thing for Oak Street. Like, these things are always going to be concentrated, but it's a win-win for the insurance companies. There was, Humana did come in April and buy some primary care physician practices in Florida. I think you remember in Florida, there's 4.5 million or 4.6 million Medicare beneficiaries. Cano's like 150,000 in Florida. It's an ant. It's just like there's so much room for everybody. The third bullet point has become an inorganic growth story. I think they kind of fixed yesterday talking about de novos, and this was a big thing with the company, which is they really underdid the de novos, and they did 2 deals, and it started looking to the street like this is a total inorganic growth story. They did the first deal, the UMC deal, just to hit 2021 guidance. Acquisitions are in guidance. And the price was 1.7 times revenue, 17 times EBITDA, pre-synergy, 9 times post-synergy. But it just wasn't a good look. The second deal they announced, the $300 million one yesterday, a little bit better, higher growth. But both of them on an EBITDA basis. I actually think UMC ends up being a better deal. But people were sort of leery of that. They fixed that. Acquisitions are out of guidance. And they really highlighted the de novos, 54 to 59 de novos that they announced for 2022 yesterday. They have done a lot of work. I had a great talk with the CFO about real estate, how they're finding great sites and how locked in these are. We're going to get more details over time. But the de novo story, I think, is huge. It's bigger than Oak Street. Florida concentration, I think, is crazy. Like, it's a huge state. They're not even penetrated, and it's one of the best states for Medicare. I think the market would like to see them demonstrate their model outside of Florida. I think this is going to become less of an issue. And I think the more they stay in Florida, I think it's a double-edged sword because it's so compelling for somebody who want in one fell swoop to get scale in Florida, just to come in, if the stock stays here, to come in and make a run at the company.
Someone had asked on Florida, is Florida the reason they're profitable versus OSH? Or is there some way, is there something about the way the business is actually run that's just fundamentally more efficient?
Yes, it's Florida. The CFO said,
but you're saying that Florida's a big enough market where that doesn't matter.
It's not just big, it's density. You have to get density. And if you talk to the CareMax guys, or if you can get any of the private guys, density is everything. And Oak Street's geography wasn't strategic, it was happenstance. They were from Illinois, and so they launched in Illinois. If you were whiteboarding this, you want to be in Florida, you want to be in dense Texas, you want to be in dense Nevada, like they're in Las Vegas now. You want people around you because then you can get scale at the clinic level. You don't want 2,000 people coming in your clinic. You want 5. You want scale with all the payers. And the more they can keep that scale, the more profitable they're going to be. With Oak Street, which is sort of just spraying the field. We've got 2 de novos in Wyoming, 1 in Idaho, 1 in Maine. Like, it's really hard to get those margins. And it's also the maturity of Cano's practices, where because Cano's mixing M&A, where you buy basically a fully ramped facility, where Oak Street, they're all de novo. So it's a 4-year ramp, where Cano, in their markets, their de novo ramp is quicker than Oak Street. And they also get bigger scale.
Got it. Any other risks related to the thesis that you think are worth going over?
Yeah, I look, we've got a pipe unlock and coming up in, sometime once the S1 goes effective. I think that's less of a risk. There's, if 50% of the people sell the pipe, you already have, of a $750 million pipe, you already got $100 million short. So that's only another $200 million. The AGL IPO is $1.1 billion. Oak Street's done a $700 million offering, a $900 million convert, a $600 million offering. Like, the demand's there. And then it really just comes down to, is InTandem going to be suicidal? I mean, they own 170 million shares. And people are like, well, they're totally unlocked. I think InTandem is going to look like every other sponsor, where you're going to get $5 to $6 million, 6 million share blocks. And after each one, they're going to have a 3-month lockup. It's going to be incredibly orderly. And I think that's just going to be a nice catalyst for the stock. And I think the offerings themselves, when InTandem, when they do sell, it's going to be a marketed offering. And we've seen it for a lot of SPACs that have done this, where the first secondary is really the IPO for the street, where new guys get to see it, they get to feel like they're getting a deal, and they come in, you get the management call, and it's sort of a clearing event that everybody, just feels good that there's actually demand for this thing.
Well, at SumZero, we love talking to folks who have skin in the game. Maybe you could just let all the listeners know kind of your own position, and also, how long you could see yourself holding on to the stock.
Yeah, this is one of my biggest positions. So I own shares and warrants, about 1.5 million shares. My clients and people I work with directly, I'd say in aggregate, own somewhere between 3 and 4% of the outstanding of the company. So it's an incredibly meaningful position for me. I think this is a multi-bagger. I mean, last year, obviously, I had a great first year. I did 278% net for clients, which was a great start. I think I've got a book right now where this year we sort of had a punt for the first 6 months while we're waiting for SPACs to close, every market thing, whatever. I love my book, and I think I got something that's a double, triple over a couple of years. And I think this is a very core part of it. My thing is I need to believe it's going to, 3 and 4 bag over a couple of years. And part of the way you do that is buying smaller companies that are going to grow. And you also get things like this, where it lines up with my biggest win last year, which is open lending. Open lending, I had 2 trades, and the ticker's LPRO. It's my biggest position, where you had that same public to private market discount, where open lending, I supersized the position at 13 because I thought it was worth 25 at the IPO, went to 25 in short order. And then from there, stock's now about $40. I think it's worth 160. With Cano, I feel very similar, which is, the sizing, you can almost be infinite here, because the public-private arbitrage is so big. It's so compelling. I mean, this thing at $20 a share is a legitimate activist pitch. Like if you were a Jana back in the day in 2005 and everything else was the same, you'd go to Barry and you'd be like, listen, we got a 45% discount to OSH. Doesn't even have to be good. Let's just buy a bunch, scream, yell, shake the tree, and maybe we get half of that. And here you already have the company in line with you. You don't need an activist. You need a suggestivist. I think they've demonstrated how they can execute. I think it's just a matter of communicating that to the street. But, I think Cano is going to be a great one. It's really a small, look, this is a small ecosystem and it's an ant in it. I think it's super compelling versus the other ones, because you get that first trade for free. The first, I joke with people, the first 75% returns free. And then after that, I think it's an awesome multi-bagger. But the risk reward here is, this is what SPAC dreams are made of, and what I try to focus on, which is stuff that, trades $10 million a day. So the King Streets, the Anchorage is where I used to work. Like if I pitched to my boss, he'd be like, $10 million a day. If I want to buy $30 million, it's going to take us a month and a half. This better be like a 6-bagger, and it's not even worth our time. But it will be worth their time in a couple years. And then for the opposite end, the retail crowd, they look at this and they're like, value-based care, complexity. I don't know. It's not an EV stock. It's not a space stock. And that's kind of like what LPRO was, where it's complicated, but simple once people figure it out. And it's stuff that the real money people are going to buy and the SPAC guys won't. And look, and I keep bringing up LPRO because it's number 2 SPAC last year behind DraftKings in terms of performance. And I think Cano is the same way. You look at this holder base; these are all pros. People get it, and it's super simple when we're going to get to membership's growing, 1.5 million people in Medicare going to, or in value-based care going to 63 million. Like this thing's going to go from 250,000 members. It's going to be 4 or 5 million members. Like,
based on your kind of your own kind of calls and just talking to folks in your network, are you getting any color from some of the real money guys that they are taking a hard look at this and seeing this as a potential long-term holding and not so much just a trade?
I mean, you already have that. So, I mean, I talk to guys in the deal, and I'm sort of, my network's kind of a hybrid. I did work at Newberger. I was like the hedge fund black sheep there. So, But I would point out Fidelity owns 25 million shares. Blackrock 8.5, Capital Group 8.5 million. And I put in the presentation really just AGL, OSH, and this one because those are the core comps. Those are the ones big enough that if you're a mutual fund, you want to buy $100 million, that's it. Like unless you're a mid cap, small cap guy, and the mid cap, small cap guys can be there. I mean, Oak Street, AGL, and Cano should all be in the S&P 500, depending on obviously when the float opens up. But just on market cap, these are all S&P 500 companies in a year. Like these aren't.
Judd, I think that's a great way to end this. I think that sums it up quite well. This is a really dense discussion. I'm going to have to unpack this later and go through it all again. But thanks so much for your time. I think people will really enjoy this, and I'll be looking forward to tracking this story as it unfolds.
Awesome. Have a good one. Really appreciate you hosting.
Appreciate it. Thanks, Judd.
Bye-bye.